Hello everyone, welcome back to Boss Economic World. I'm your host, the Boss. We analyze the truth behind the money, stripping away the jargon to show you the naked reality of the financial game. Today is December 19th, 2025. Put down your coffee, stop checking your crypto portfolio for a second, and look at me. We have reached a historic moment. A moment of silence. A moment of absolutely nothing happening. Yes, you heard me right. The European Central Bank, the guardians of the euro, the folks who have been treating your mortgage rates like a yo-yo for the past 3 years, have finally decided to put the toy down. According to people familiar with the matter, the guys in the expensive suits whispering by the water cooler in Frankfurt, the great cycle of interest rate cuts is officially, most likely, probably, over. We are sitting at a deposit rate of 2%. And if the ECB has its way, we are going to be sitting here for a long, long time. Today, we are going to tear apart this non-decision. We are going to look at why they stopped, what Christine Lagarde is actually saying behind the data-dependent word salad, and most importantly, why the year 2028 is suddenly the magical promised land. We're also going to discuss whether this 2% floor is a safety net or a concrete ceiling that's going to keep the European economy hunched over for the next 2 years. Let's get into it. So, let's set the scene. It's a chilly Thursday in Frankfurt. The ECB policymakers gather. The world is watching. Traders in London, New York, and Tokyo have their fingers hovering over the buy and sell buttons. And what happens? Nothing. But, as always in the world of high finance, the real news didn't come from the podium, it came from the shadows. Bloomberg and other outlets reported that officials, asking not to be identified because, God forbid, they actually take public responsibility for a thought, believe the cutting cycle is finished. Think about the journey we've been on. Just a couple of years ago, we were staring at a peak deposit rate of 4%. Remember that? Remember when borrowing money felt like asking a loan shark for a favor? The ECB hiked rates to crush inflation, effectively strangling the economy to stop it from overheating. Then, realizing they might have choked it a bit too hard, they started the great easing. 8 cuts. Count them. 1, 2, 8 times they trimmed the fat. We slid from 4% down to 2%. And now, the car has stopped. The engine is idling. Why? Because apparently, 2% is the Goldilocks number. Not too hot, not too cold. Just right. Or so they hope. The leak suggests that unless there is another major shock, and in this decade, a major shock is about as rare as a rainy day in London, meaning it happens all the time, the rate stays at 2%. Any talk of raising rates? Premature. Any talk of cutting further? Unnecessary. Basically, the ECB has decided to put the Eurozone economy on cruise control. But here is the boss's question for you. Have you ever tried to use cruise control on a road full of potholes? Because that is exactly what the European economy looks like right now. Now, let's look at the official narrative. ECB President Christine Lagarde faced the reporters. Now, I love Madame Lagarde. She has an incredible talent for speaking for 30 minutes without giving you a single tradable sentence. She told reporters that neither hikes nor cuts were even discussed on Thursday. Can you imagine that meeting? So, fellow governors, shall we raise rates? No, shall we cut them? No, okay, lunch? I'm joking, but only slightly. Lagarde dropped her favorite buzzwords. She said there was unanimous agreement that all optionalities should be on the table. Optionalities. It's a beautiful word, isn't it? It sounds sophisticated. It means we have no idea what is going to happen next month, so we are keeping our options open. She reiterated the meeting-by-meeting approach and data dependency. Let me translate data dependency for you into plain English. It means the ECB is driving looking exclusively in the rearview mirror. They don't look at the road ahead, they look at the inflation print from last month, the GDP figures from last quarter, and they steer based on where they were, not where they are going. She said, we do not have a set path for our rates going forward. This is the central banker equivalent of a shrugging emoji. Woman shrugging. But don't be fooled. This ambiguity is calculated. By saying they have no set path, they prevent the market from betting too heavily against them. It's a poker face. But the leak from the anonymous sources tells us the real hand, they are folding. They are happy with 2%. Why are they stopping at 2%? To understand this, we have to look at the battlefield of the 2025 economy. The ECB economists have raised their growth forecasts. They are patting themselves on the back. Look, they say, the Eurozone didn't collapse. And it's true. We didn't have the Great Depression 2.0. But let's look at the data. The upgraded growth forecast is still, let's call it modest. We aren't seeing a roaring 90s style boom. We are seeing a slow, grinding recovery. Germany, the traditional engine of Europe, is still coughing. The transition to green energy has been expensive. Their industrial base is facing stiff competition from Asian EVs and American tech. The fact that the ECB thinks the economy can handle a 2% rate tells me one thing: they believe the patient is out of the ICU, but they are definitely still in the hospital ward. But here is the kicker: inflation. The ECB predicts inflation will return to the magical 2% target in 2028. Wait, 2028? Friends, it is December 2025. That is 3 years away. And get this, they predict inflation will actually be below the target in 2026 and 2027. This is the absurdity of modern economics. They are worried that inflation might be too low for the next 2 years, yet they are refusing to cut rates further. Why? Because underlying price growth is seen stronger than the headline number. This is the sticky core argument. Headline inflation might be dropping, but services inflation, haircuts, insurance, wages is still bubbling. The unions in France and Germany have negotiated higher wages to catch up with the cost of living. The ECB is terrified that if they cut rates to 1.5% or 1%, those wages will spiral out of control. So, they are choosing a strange path: accept below target inflation for 2 years just to make sure the inflation dragon is truly dead by 2028. It's like taking antibiotics for an extra week after you feel better, just to be sure. But in this case, the antibiotics make you lethargic and kill your appetite for investment. How did the money men react? The 2-year yield, the number that basically tells you what the market thinks rates will be soon, edged up. It went up nearly 1 basis point to 2.14%. 1 basis point. For those not in finance, a basis point is 0.01%. A movement of 1 basis point is the financial equivalent of a polite cough. Why such a small reaction? Because the market already knew. The investors, the hedge funds, the algorithms, they have already priced this in. They looked at the same data Lagarde looked at. They saw the sluggish manufacturing numbers, the stubborn wage data, and they concluded, yeah, 2% sounds about right. Investors are pricing little chance of movement in either direction soon. This is actually a very dangerous state for a market. Markets love movement. They love volatility. When things go flat, when volatility dies, leverage builds up in the shadows. Everyone gets comfortable. Oh, rates will stay at 2% forever? Great, let me borrow at 2.5% and invest in risky assets yielding 4%. This is the carry trade of the mid-2020s. And when everyone stands on one side of the boat because the water is calm, that is exactly when a rogue wave or a major shock capsizes everything. Let's take a step back and put on our professor glasses for a moment. We need to talk about the neutral rate, or what economists call R. The neutral rate is the theoretical interest rate where the economy is neither speeding up nor slowing down. It's the equilibrium. For the last decade, the neutral rate in Europe was basically zero. Or even negative. Remember negative interest rates? That was a weird time. You paid the bank to hold your money. Now, the ECB seems to believe the new neutral rate is around 2%. Why the change? 1. Demographics, the workforce is shrinking. Labor is scarcer. That pushes wages up. 2. Deglobalization, we aren't buying as much cheap stuff from halfway across the world. Supply chains are shorter, more secure, but more expensive. 3. The green transition, replacing cheap Russian gas with renewables and LNG is capital intensive. So, the boss truth is this: the era of free money is dead. 2% is the new zero. If you are a business owner waiting for rates to go back to 0.5% so you can expand your factory, don't hold your breath. It's not happening. You need to build a business model that works at 2% or 3% cost of capital. If your business only works with free money, you don't have a business, you have a hallucination. Now, I want to address the one policymaker who issued a warning. Did you catch that in the report? One policymaker cautioned that further easing is possible should inflation undershoot the target for several months. This is the voice of reason in the room. This is the guy looking at the 2026 forecast where inflation drops below target and sweating. If inflation drops to 1.5% or 1.2% while rates are at 2%, the real interest rate actually goes up. Monetary policy gets tighter without the ECB doing anything. This leads to what I call the zombie scenario. In this scenario, Europe doesn't crash. It just drifts. Growth stays at 0.8%. Innovation lags behind the US and Asia. Young people struggle to buy homes because mortgage rates settle at 3.5 to 4%, but their wages aren't growing fast enough. The ECB's obsession with the 2% inflation target in 2028 might be blinding them to the risk of 2026. They are fighting the last war. They are so traumatized by the inflation of 2022 to 2023 that they would rather risk a recession than risk inflation coming back. It's understandable. But it's painful. Let's look sideways. While the ECB parks the bus at 2%, what is the rest of the world doing in late 2025? The US Federal Reserve likely stopped earlier, perhaps settling a bit higher due to the American economy's relentless ability to consume. This interest rate differential keeps the euro somewhat weak against the dollar. That's good for German exports but bad for energy costs. Meanwhile, in Asia, economies are dealing with their own structural shifts. The world is fragmented. The synchronized global moves of the past are gone. The ECB is on its own island. So, what is the takeaway for you, the viewer? 1. Mortgages. If you have a variable rate mortgage, congratulations, your pain has peaked. But don't expect a massive refund. Fixed rates will price in this 2% forever narrative. If you can lock in a decent fixed rate now, do it. We aren't going back to 1%. 2. Savings. Finally, cash is not trash. Getting 2% on a risk-free deposit is better than the last decade. It's not making you rich, but it's not evaporating. 3. Investments. This environment favors companies with real cash flow. When money costs 2%, you can't survive on hype and total addressable market dreams. You need profits. The stock market will separate the wheat from the chaff. The ECB has declared mission accomplished on high inflation. They've brought the beast down. But in doing so, they've built a cage around the European economy. A cage made of 2% interest rates. They say they have no set path. They say they are data dependent. But the truth is, they are hoping that by doing nothing, everything will fix itself. It's the ostrich strategy: stick your head in the sand and hope the storm passes. For the next 2 years, unless a crisis hits, boring is the new exciting. But remember, in economics, when things get too boring, that's usually when the dynamite goes off. Stay watching the yield curve. Stay skeptical of the unanimous agreements. And most importantly, keep your eyes on the data, because the boss is always watching. I'm the boss. This is the truth. See you in the next episode.